So we talk a lot about crafting an investment thesis, and now it plays a major role in your buy and sell decision. But what does that mean? How do you craft one? Today we're going to explore and we're going to help you how to craft an investment thesis.
Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement.
Dividend investors, bonjour. Mike Leroux here. You're listening to the Dividend podcast. Dividend investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am in good hands with my co-host, Vero. How are you doing, Véronique?
I'm doing good, Mike. Maybe we're due for vacation. This is going to happen soon. Maybe that's why.
It's coming. It's coming. Like in 10 days, I'll be flying. Right, less than 10 days, actually. 9 days. So I'll be flying out. You're not too far behind as well. Mm-hmm. Yeah, we can feel it now. It's like any day would be a good day to leave. So,
but before we do so, we're gonna give you stuff to work on if you feel like it. And I mean, today's the day. You'll never want to buy a stock without an investment thesis. Again, I promise you, we often talk about it. We never really explained how to build a robust investment thesis to invest with conviction. So we will do it today. And to clearly illustrate how to craft it, I will put you to the test, Mike. We will use two examples, Alimentation Couche-Tard and BCE. So we'll see which one is really better, right?
Yeah, okay, so we're really going to the extreme. That's great. Just to mention, though, the goal here is not to compare both stocks. I mean, and first, if you want to compare, you have to compare within the same industry, please. You cannot go just say, oh, this investment is better than the other one. But what's going to be interesting using the framework to craft your investment thesis for those two stocks, we're going to discover that nothing is perfect, of course, but nothing is all bad either. So it's not the day where I take my baseball bat and I just start hitting on BCE minutes after minutes. Yeah, I'm not going to try to bury this stock. Definitely not. What I want to show here is how you can craft the investment thesis and then decide if it's a good stock for your portfolio or not. And as obvious as it seems, it is often a step that is forgotten by a lot of investors. They actually start with the first part of the investment thesis that we're going to talk about today, and they skip the other three parts and they skip what's coming up after. They're just stick to step number 1 out of 10. And it was guys, there are a lot of things that you should be doing instead of just doing, oh, we're going to stick with the narrative. It's all good. I have a good story. I know what to buy and then I'm gone. Yeah, that's not how it works. And this is what we're going to discover through those two companies.
All right. So first of all, let's define the role of an investment thesis. Simply put, it could be seen as the bull case, right?
Yeah, it's pretty much the bull case. It's everything that is positive about a stock. Basically, why are you excited to buy this stock or to have it in your portfolio? So we're really going to look at all the company's good sides, potential, and everything that makes us want this company in our portfolio. I am a big fan of this quote from Peter Lynch: know what you own and why you own it. Well, this is exactly what the investment thesis is about. So understanding truly why you have this company in your portfolio. And ironically, once you do that, you kind of solve so many other dilemmas and problems and doubts that you're going to have going forward managing your portfolio. So anyways, I had a lot of fun to prepare for this episode, and I hope that you're going to have a lot of fun listening to it and you're going to get some of those steps in that framework to help you make better investment thesis and then make your buy and sell decision a lot easier.
And you know what? I just feel like we need to mention that at Dividend Stocks Rock, we used to write an investment thesis just a paragraph. But then over time, we realized that it's better to break it down into 4 parts, which makes it very more complete and useful. So the first one is the narrative. What is it and what do you include in it?
Yeah, so the 4 part that we we started to offer at Dividend Stocks Rock, I think is the best way to really grasp what this company is about. And of course, when you start with the narrative is really like the short story you would tell your friend about a stock. Like, why do I have Alimentation Couche-Tard in my portfolio? Why I don't have BCE in my portfolio? It's really just like a few sentences that will be the summary of the rest of the parts of the investment thesis. So the point here is just to have like a global overview, like really quick, kind of like an elevator pitch, but for the stock that you have in your portfolio, basically.
Now, what's the narrative for Kushtar and BCE?
So we're going to keep it very high level at this point, and then we're going to dig down. So the narrative for Kushtar, I mean, it has a dominance presence in the convenience store world, right? They operate over 16,000 convenience stores across the world, and they have a great mix of organic growth, so selling more stuff inside their convenience stores, and growth by acquisition, which they have been like well famous known for, especially like the acquisition of Circle K that completely transformed the business a while ago, and more recently Total Energy's gas station. Then for BCE, well, it's one of the big three in the telcos. So it's a cash cow making money through like wireline and wireless services. Clients are kind of like attached a little bit to this type of business because they're paying those subscription. They kind of need access to smartphone data. They need access to internet. So that's the narrative here. So a big company in an oligopoly, well protected, been around for a long time.
Second part is the playbook, or how the company makes money, right?
Yeah, so the playbook is how can I explain to a 12-year-old how this company makes money? And to give you an example, like we made actually an episode on that, but that my children started investing at a very young age. So my daughter and my oldest son started at 12 and 14, and then Caleb started at 10. And do you know which are the two companies my kids bought first when they started to understand a little bit more about how it works?
I think Starbucks is part of it. I'm not sure which, about the
It
other
was
one.
not part of like the first two, but it was like probably the third one or the fourth one. So you're pretty close, actually. So the first one they bought was Apple. Apple, because they were all craving to get an iPhone back then. It was like making it so simple for them, understanding Apple sells iPhones. I want an iPhone so bad that it kind of makes sense to buy Apple stocks. It's very basic here. We're not like changing the world. And the second stock was Alimentation Couche-Tard.
Because you talk so much about it.
Yeah, that's one part. But the most important one was actually not their father, but most of the time is, well, they get a slush from there. They get their Doritos from there. It was like the first time they started to get outside the house. I mean, we have a Kushtar like 1.5 kilometers away. So the first time they started to cycle around with their friends, well, they headed on to Kushtar buying some chips and other stuff. So it was part of their like daily routine, weekly routine to see the convenience stores, to go there. So it was really easy to understand, well, a Kushtar runs convenience stores. You get in the store, you buy stuff, you get out of the store, boom. They make money and you're happy. So it's really about figuring out how the company makes money, but in a simple way. And then this is also an important part where if you're not able to put it to its simplest expression, it's probably because you don't understand the business model correctly. Like for an insurance company, for example. Well, an insurance company, what they do is they have to figure out how much they charge for the insurance versus how much they generate while they get that money before they have to pay. That's their playbook. That's like how they make money. So it's just, oh, you want your house insured? No problem. Now I need to run complicated calculation to know how much money you're going to pay me while I'm investing that money, trying to make more money out of it versus what are the likelihood I'm going to have to pay you back like in the next year, in the next 5 years, in the next 10 years. So it's all about kind of like an arbitrage between the money you get, the likelihood that you have to give it back, how much you have to give back, and in the meantime, what's the likelihood of how much you're going to make investing that money. Once you have highlighted the playbook, then you know how to identify the strengths and the flaws of a business model.
So what would be the playbook for our two examples?
So Couche-Tard already like kind of sold it a little bit, but convenience stores, 50% merchandise, so snacks, beers, cigarette, more food, and then 50% fuel. Roughly, that's the playbook. It's a game of location, because, I mean, it says it, you want to be convenient. So if you open a convenience store in the middle of a rural area, probably not going to be the most prolific convenience stores. You're going to leave that to some independent, and you're going to focus on urban areas, or you're going to concentrate like towards like the highways and stuff like that, easily accessible, reaching out a lot of people to make sure that they're there. So it's a game of location, loyalty programs, pricing, and promotion. So you want to attract people inside your stores so you can sell them snacks, foods, and so on. For BCE, here's the thing. Someone would be tempted to do the financial analyst and say, well, it's a telecom companies doing wireline, wireless, and media and broadband services. All right. Do you really think your 12-year-old hasn't understood that? I'm not too sure. But you can say BCE is like very good because they are providing everything that you need to run your smartphone. So data, a line, they have internet, they offer TV, and they charge subscription. So subscription equals recurring revenue. So every month you pay for your bill to get access to your phone, to get access to data, access to the internet, and to watch TV. Super simple. Clients are attached there, and this is how they make money.
Next, you will look at growth vectors. So what should investors consider in this part?
So now you know how the company will make money. That's great. But do you know how it will grow? Because if you don't grow, you die. And I mean, you know that, Vero, for working with me for the past 15 years, I'm obsessed with that. Even for my business, I need to see the business going and growing their revenue, because then I think, well, if I'm not growing the revenue, I'm going to die. Like the business is going to die and it's going to be over. And the stock market is quite cutthroat with that thought too. They expect to see continuous growth all the time, which is a pretty high level of expectation. And while I am obsessed with growth, it's important to understand that setbacks exist. So it's normal from time to time to see that revenue goes down or earnings goes down. It is totally acceptable, because as you are in your life, you're never at your best self every single day and every single minute of your life. Well, a business is the same thing. Thing happens, the economy happens, whatever. And then you have bad months, you have bad quarters, which is normal. But overall, you need to know, okay, so how are you going to increase that revenue level to eventually increase more earnings and eventually increase your dividend?
Okay, so what would be the growth vectors for Kushtar and BCE?
So Kushtar has a lot of growth vectors. They are known to grow by acquisition. So of course, it creates more sales. They have an impressive expertise there. So their playbook is perfect. They create synergy, which increase profit. And they are very good at changing the stores they acquire to improve them, making more efficient and generate even more growth there. After that, they also go through food and beverage expansion. So they offer like prepared meals, more fresh food. They want people to consume more stuff inside their convenience stores. They bring loyalty programs, so they get more people to buy their stuff regularly, and they are able to target them with promotion that will drive them inside the store, because it's always the same playbook here. You want people to go into the store thinking they're just going to buy like a pack of beer, but they get out with chips and sneakers and whatever on top of that, and then you have made your job. Ironically, EV charging could also be seen as a growth vector, because EV owners have to stop a longer time to charge their car. So technically they have more time to go inside the convenience store and buy more stuff. So doing actually quite well in Europe, in Norway, where they have established more EV chargers, and they're growing their EV charger network based on their high quality location. Now for BCE, well, we have the expansion of 5G. So we're talking about internet data and cell phone data. Well, of course, we consume more and more data with our phone. So the 5G is great for that, a great way to increase revenue and to provide a more reliable network. They also go about a lot more internet. So they want to expand their fiber network. Again, actually, it's kind of ironic because I am a client at Bell, mostly because their internet is like very high speed and offer a great stability. So those are like the reason why I've picked that one. And of course, this show is not sponsored by BCE because I'm known to not talk greatness about this one. But I mean, and that was like the interesting point of this show, is to show that nothing is all bad. So BC still has some strengths, and they came up with the acquisition of Ziply Fiber. So wanted to also now expand Ziply in the US, providing more internet connection and cell phone over there. So they're well established in Canada. Now they want to expand in the US, and this is how they intend to keep on growing.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. You know, our goal is to help more investors just like you, so please spread the love. Thank you. All right, so the last section of the investment thesis is the economic moat. So what's a moat, Mike?
So we did a full episode on that, actually. It was quite interesting. Right. So the moat is a protection, is your competitive advantage that most competitors will not be able to do anything about it. It's the ultimate protection. You can think of like companies like Visa and MasterCard versus their network effect. So more people use Visa and MasterCard, more merchant are going to accept it. And the more merchant they accept it, well, the more people will use Visa and MasterCard. And I can tell you that I do have an aerial plan American Express, and I keep trying to use it all the time, of course, because I get bonus points and stuff. So I love it. Man, it's frustrating when they decline it. They're just like, nah, no, we're not taking American Express, but we do have like Visa and MasterCard. So it's impossible for me to discard my MasterCard for that reason. I will still use Visa or MasterCard for most of my purchases. And then when I can, I'm going to use American Express. But if you force me to have only one card, that's not going to be my Amex. So just to show how important that protection could be. Facebook is another one. I mean, the more people you get on the network, the more people consume the content and the more people create the content. And more content you have, the more you're going to attract people. And the more people you get, the more content you get. So you see, you got that wheel spinning like there's no tomorrow. And today, if I want to create another Facebook, man, I have a lot of work on my hands, and I don't think I'm going to be able to do it. So I can create alternative, or I can go niche, but trying to build a larger place where more people connect than Facebook, almost virtually impossible these days. So this is a moat. It is something that actually protect your playbook and protect your growth vectors, like increasing the chances of actually achieving those goals.
And there are different types of moats too. So I will put the link to the episode we did on that in the show notes at thedividendguyblog.com/236. How would you describe the economic moat for Kushtar and BCE, Mike?
Well, for Kushtar, pretty weak moat, I would say. I mean, it's a convenience store. Literally anyone could open a convenience store and do some business, right? So at this level, not much of an advantage. Where Kushtar has major advantage, there are like two places. Economies of scales, because of course, when you have 16,000 stores, you kind of have a little bit more purchasing power, versus someone like me that just opened a convenience stores around the corner, right? I'm not going to buy as many beers as Kushtar. When I will sat down with Molson Coors, I'm not going to get a good deal versus them. And the second thing is their merger and acquisition expertise. So they have an amazing management team. While it's not protecting their business, but if you look at different other convenience store operators, they do not have that expertise and this ability to make those acquisitions. They're paying the right price, having this discipline to get out of a deal when it doesn't make sense. This is what their management team is about. So it's a great competitive advantage, but it's not a strong moat altogether. And what's interesting is on the other side, Bell BCE has like very strong moat. I mean, first they have like very high barriers to entry. So it's incredibly capital intensive. They operate in an oligopoly where like the big three, Rogers, Telus, and BCE owns like 90%, I think, of the wireless business in Canada. It's like just huge numbers. So it's really, really tough to get in. And on top of that, you have like tons of regulations. So again, if I can open a convenience store tomorrow morning, I certainly cannot start Mike Mobile tomorrow morning. That's not going to happen. The other thing is, of course, with this size, they also benefit from a lot of economies of scale and their wide network. So wherever you live in Canada, you have access to the BCE network. So that's also another strong moat for them. It's really hard to compete against those.
Okay, so quick recap. We looked at the narrative, the playbook, the growth vectors, and the economic moat. At this point, Mike, which one looks more appealing? And by the way, you almost got me interested in buying back BCE at this point.
I know, I'm doing a pretty good job, right? And this is actually why I wanted to take those two stocks out of like thousands that we could have selected. Is when you think first sight, I mean, BCE looks almost better than the convenience store operators. I mean, it brings in more stability, a stronger moat. Obviously, it's a service that is a lot more important and people are a lot more dependent on their phone than going to the convenience stores. I mean, I think so anyways. So I would rather get my iPhone working than having a bag of Doritos and a pack of beer. Mind you, that's interesting too. But anyways, get the point. So that's why I wanted to show you that you cannot stop there. You need to have one more step. So far, we just went with the qualitative information. And that's what the investment thesis is about. Really understanding the business, really understand how they make money, how they grow, and how they can protect their business model against competitors. But then the next step is to look at the numbers. The numbers will tell you a stronger story than just writing the story by yourself. And it will also confirm or not if your thesis is the good one. You know, for example, you can tell me how fast you run because you have like 3 Ironman winner in your family. You have been training with Usain Bolt and you're on a high protein acai berries yogurt diet that is going to make you lean, strong, and fast. Well, that's a great story, right? But I want to see your Strava stats because I don't really care about your story if I don't see you running for real. So I want to see the numbers. I want to see the pace. I want to see how many kilometers you run. And then I'm going to decide whether or not you're a good runner, not just the story. So a good way to do that is to actually use the dividend triangle. So looking at the trend over the past 5 and 10 years for revenue, earnings, and dividend. It's going to tell you a lot about what's happening. And then you can put your investment thesis into a context, which is, for me, crucial. So when you look at Alimentation Couche-Tard, for example, you will see that even though a lot of people will say, well, and it's true, convenience stores, recession resistant, quite resilient. People will still go there. They still need to fuel their their cars and stuff. So it makes sense, but it is cyclical. When you look at the dividend triangle, you will see that yes, it's not like crashing and burning during a recession, but when consumers have less money in their pockets, you clearly see the revenue and the earnings slowing down, which explains actually what's happening right now, which explains what happened around 2017, 2018. So again, if you look over the trend 5-10 years, from time to time, you will see revenue and earnings taking a break, taking a small slope, and then it's going to come back for the growth vectors and everything that I've explained so far. For BCE, you look at the dividend triangle, and now you see revenues are stagnant. So we've been told that with 5G and more services and higher prices on internet and so on, the revenue is going to grow. But right now it's barely matching inflation. We're talking like 1-2% per year. So not much. And the most important part is we see declining earnings. So that's bad. I mean, we have earnings going down. And then you may be thinking, okay, so earnings is like just one part, but it's opening the doors to investigation. You see the earnings going down, and then you cannot just discard that thinking, oh, earnings per share is based on accounting principles, so it's probably not good because we should look at cash flow. Well, there you go. look at operating cash flow, look at free cash flow, look at capex. And then once you have covered those numbers, you would have looked at the dividend sustainability, which was close to zero at one point. And this explained why the company, because it was short on cash, had to cut their dividend. There was an explanation that was clear, but you went from the investment thesis that everything was great cash cow, cash flow is stable, recurring revenues through subscription. All that story is great. When you verify that with numbers, then you have the full story. You have kind of like the conclusion. And it makes it a lot better to understand if this is a good business for you or not.
And now, I mean, the investment thesis per se is completed. You've compared it to numbers, but you can't decide solely on that without also building a bear case, right?
Yeah, I mean, it's easy to get excited, right? I even got you excited to buy Bell. I mean, like, I just hope that you like close your broker's account while we're talking, because maybe you're just like, oh, wait a minute, there's a bear case. There's a possibility that things could go wrong. Like, do you mean I can lose money when I invest? Well, unfortunately, that's the truth. And it sucks. It really sucks. I keep saying that, like, there are risks and there are like potential downsides for all companies. The key here is not to freak out when you identify them, but rather determine if you are comfortable with this kind of risk. It could be risk regarding like lawsuits. Like, I don't like those kind of risks because it's impossible to predict. It could be about product innovation. It could be a shift in the market. I mean, we're going to talk in a second, but I mean, Kushtar, of course, they're selling a lot of fuel, and ICE cars, maybe they're not going to be around in 20 years. So what's going to happen with Kushtar? So there could be like plenty of different types of risks. It could be like management team that they're kind of shaky. Now you need to determine which one you feel good about. And as much as it's important to understand the upside potential, you need to understand the downside potential before you pull the trigger.
Listeners, let's empower you in the investment world with our free dividend Rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. So in the bear case, you include business vulnerabilities, industry and market threats, and competitive landscape. What does it look like for our two examples?
So it's quite similar the way that we have put the framework for the investment thesis, where we have the narrative, which is the overall summary. We have then the playbook to understand what the business model about, the growth vectors, how it's going to grow moving forward, and the economic mode, how it's going to continue to be better than competitors. Then to build the bear case, to build the potential risk, I have like 3 different points. So the first one, the business vulnerabilities, is everything that is related to the business model. So you can now understand that you need to write about the playbook first to understand what could go wrong with this business model. Then you have industry and market threats. So everything that is external, the company has no control over that. They just have the control of how it will navigate through those threats. And finally, you look at competitors, because competitors for two reasons. Maybe there's a better company out there that you should probably buy instead of this one. And also understanding like how competitive this market is for this business. So that will lead you to understand a little bit more how operating margins are going to be. So highly competitive, thin margin, you're alone in your space, well, then you have like the ability to increase your margin. So let's get started with Kushtar. So business vulnerabilities. What could go wrong with their business model? Well, their biggest growth vector is acquisition, which is far from being stable. So from time to time, it goes well. From time to time, there's nothing to buy. So you're kind of stuck not being able to acquire something. So not that great. As of late, it's been almost a year now that we have that story about acquiring 7-Eleven stores. Will it do it? Will it not? Is it going to crash their balance sheet with too much debt? We don't know. So that is a business vulnerability. Another one is the fact that they're trying to compensate for a lot of market threats that we're going to get into a moment by offering more fresh produce, packaged meals, and stuff like that inside their convenience stores to grow organic growth. The battle is not won there. It's not obvious that they will make more growth with this because it's a completely different ball game to manage perishable food versus something that can stay on the shelf for like 3 months without any problem. And finally, as I said earlier, Kushtar is resilient during recession, but it is still cyclical. So you're going to have bad years. And then you have, like, as an investor, you have to be prepared to be patient during those bad years because they're going to always come around every 4 or 5 years or something like that. Now you look at the external threats, the industry or the market. So the shift toward electric vehicle, it's doing not that bad so far, but it's not proven that they're going to actually grow faster with EV chargers and people going to the convenience stores. That's still a theory, not necessarily something that is happening right now. The shift towards healthier food and the decline in cigarette sales. That's why they also push a lot forward selling fresh food and prepared meals. So yes, there's a good margin for that, but is it going to be enough to compensate for the declining in cigarette sales and the shift towards healthier food? So we don't know about that. That's definitely another risk. Finally, competitive landscape. Well, in this case, they're like one of the biggest player in town. They don't have to worry too much about small competitors. However, location is super important. So they still need to fight against 7-Eleven, and especially in the US. How this story is going to end up. Are they going to be able to acquire it or not? And is it going to be worth it? So this is where, I mean, if I compare 7-Eleven as an investment versus Kushtar, it's a no-brainer. I'm going to stay with Kushtar. But still, right now, there are like a lot more 7-Eleven. I think it's like 85,000 convenience stores versus 16 for Kushtar. So Kushtar's making more money, but still a lot smaller in terms of location. And as I said in the beginning, it's a game of location. I mean, if you're at the right place, you're going to have the right traffic and more people is going to come to your store and you're going to make more money. Moving on to BCE, business vulnerabilities. Well, that's what led to their dividend cut. Highly capital intensive. They need to spend billions into capital expenditure. So if you fail to grow your revenue, which they did, that's going to be a problem. The debt load is another problem. So interest charges, they have to pay a lot more interest right now than they used to. And they still need to spend all that money to maintain and improve their network because if not, they're going to lose to the competition. They made the acquisition of Ziply. They want to expand, but again, we have a cash flow problem. So they had to cut their dividend for that. And they also had to partner up with PSP Investment to sustain the growth. So they need more cash flow for that expansion. So it's a great story on the investment thesis, but it's also a great risk on the business vulnerabilities because they might as well kind of do with like the 5G and spend tons of money into Ziply and not necessarily generate that much cash flow. Of course, they believe they will, but I mean, that's the whole point. Management job is to sell you the idea. They sell you their investment thesis and to minimize the bear case, of course. Industry and market threats. Well, there is a pro and there is a con to be in an oligopoly. It's great for protection, not so great for growth. I mean, it's very tough to grow when everyone is pretty much your size and offering about the same service. So people are going to like switch from one place to another, but that's pretty much it. So you kind of rely a little bit more on demographic growth. And if we don't have more people in Canada, well, Bell is going to have like more cell phone bills to people to charge. So that's a big break on their growth as well. finally competitive landscape, pretty much having to fight with Rogers, Telus, and to a smaller level, Quebecor. That means that they're all super big. They all have like a lot of money. So margins are going to be hurt every single time. So it's always a game of trying to attract new customers. But if you're not getting demographic growth, you have to steal away customers while you must protect yours. It's kind of like all those games that we used to play in elementary school, right? You have like, you need to steal something from the other team, but you have to protect your flag or something. Just make sure that you're not going to get your flag caught at the same time, because you may as just steal as many flags or balls if someone else is taking all the others that you have stored. You're not necessarily going to win the game. So it's kind of like really hard to come back full circle and become a winner out of that kind of game.
All right, so finally, I'm glad that I sold BCE and kept Alimentation Couche-Tard, Mike. But here comes the conclusion. Crafting a complete investment thesis, compare it to the numbers, and then having a bear case makes buy and sell decisions easy. You then know what you own and why you own it. Now, having an investment thesis for each of your holdings is part of the DSR Investment Road Map. How can this roadmap help listeners even more, Mike?
So I created the DSR Investment Roadmap after a discussion with one of our members, Brad. And the idea came because he had a lump sum amount to invest, but he was like, Mike, I don't know where to start. I mean, there are so many companies, there's so many strategies, there's so many sectors. How do I shape that? The number of stocks, how I can distribute all my money into that. So I thought, okay, so what you need is actually just a step-by-step methodology to make your choices at each of those levels. So what we did is we created this roadmap that would work if you have $100 to invest or 100,000 or 10 millions. The point is how you can start from having dollars in your account to build a full portfolio. So the framework has been created to kill the noise, kill hesitation, and just push you towards taking action, but in a confident way, because you know what you're doing and why you're doing it. See how it has been, though, know what you own and why you own it?
So you can enter your name and email at thedividendguyblog.com/roadmap to get it in your mailbox. Thanks once again for your clear guidance on crafting an investment thesis, Mike. Listeners, remember to download your DSR Investment Roadmap. Again, thedividendguyblog.com/roadmap to download it. For our show notes and related content, visit thedividendguyblog.com/236. And next week, we will discuss high yields that we like. So hit the subscribe button underneath our podcast logo so you don't miss it. Leave us a 5-star rating while you're there. Until next week, stay invested.
Stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.